Stablecoins collectively are the 12th largest holder of U.S. Treasuries. They own twice as much as Germany, for instance. The U.S. government does, in fact, want stablecoins to proliferate because it's a guaranteed long. Stablecoins never have declining assets of U.S. Treasury markets. And dollar dominance is only 27% in GDP terms. It's 88% in traditional financial market trading. 80%. It's 100% of the quoted pair in crypto. Dollar dominance is stronger in crypto. Stablecoin usage is only 20% in the US. Almost 60% of stablecoins trading takes place in Hong Kong, China, and Japan. So you can see that it's creating more demand for dollars outside the US.
What's happening isn't a crypto boom. It's a monetary transformation. Quiet, unfolding block by block. The rails are already being laid beneath your feet, whether you realize it or not. Bitcoin and stablecoins are becoming the TCP/IP of finance, invisible, essential, and impossible to shut down once integrated. Let's take a closer look at how this transformation is actually playing out in the real world. Start with remittances, the lifeline for over 800 million people globally who depend on family abroad to send money home. In countries like Nigeria, El Salvador, the Philippines, and India, middlemen have traditionally extracted 5 to 10% just to move dollars from one place to another, sometimes taking days. Today, a growing number of these payments are happening over USDC or USDT, with settlement occurring in seconds, fees slashed to near zero, and Bitcoin acting as the final settlement layer in the background. This isn't hypothetical. Tens of billions in annual remittances are already flowing through crypto rails, and major players like MoneyGram, Western Union, and PayPal are scrambling to integrate Web3 wallets just to keep up. Because here's the uncomfortable truth: they're being disintermediated by code. And why does this work? Because stablecoins offer what traditional fiat can't: programmable money, borderless by design and trustless in architecture. Combine that with Bitcoin, a digital bearer asset with final settlement properties stronger than gold, and what you have isn't just disruption. You have the emergence of an entirely new monetary operating system. In fact, BlackRock's Larry Fink recently referred to Bitcoin as international collateral, a phrase once reserved only for sovereign debt and gold.
I think Bitcoin's utility is going to go up exponentially in the next 10 years. So one of the reasons Bitcoin has risen to 100,000 is just simple network value. When we first wrote about Bitcoin in 2017, and Bitcoin was under 1,000, we had said it could get to 25,000 by 2022 because it's a network value asset. So we just said, if you model number of wallets and activity per wallet, which explained 90% of the move of Bitcoin from 2009 to 2017, you would get to 25,000 2022, and you can get to the six figures later. And that's true. It's still like 87% explained by those two variables. But Bitcoin is now about to become a lot more useful for two reasons. One is it's becoming less regulatory burdened, right? The White House is really creating it as a strategic reserve asset, and companies are putting it on their balance sheet because it's the way people used to have real estate owned in retail. Like, that wasn't a thing, but then people realized it was valuable to own the real estate. Like, some retailers are more valuable because they own the building. That's what Bitcoin is, your working capital is. And then, but banks are also quite interested in Bitcoin because of stablecoins.
Wall Street is beginning to recognize what crypto natives have understood for years. Bitcoin is becoming the new monetary base layer. Stablecoins are the middleware. Apps and wallets are the new front-end banking layer. And the old financial stack, it's slowly becoming the legacy stack. Now consider this. Over 1.4 billion people are still unbanked or underbanked. That's nearly 1 in 5 humans locked out of the formal financial system. Not because they lack value, but because the traditional banking system was never designed to serve them efficiently. Stablecoins on open blockchain networks change that. All you need is a smartphone and an internet connection. Boom! Instant access to the dollar, to global liquidity, to marketplaces previously gated behind fees, paperwork, and prejudice.
But here's the kicker. This shift doesn't weaken Bitcoin, it strengthens it. Because every transaction, every token minted, every smart contract executed ultimately relies on a secure, censorship-resistant, value-stable foundation. And that's where Bitcoin enters, not as a competitor to stablecoins, but as the anchor of trust. It's no coincidence that as Tether, USDC, and other stablecoins have exploded in usage, Bitcoin's role as settlement and assurance has grown in tandem. The security budget of the Bitcoin network, fueled by its hash rate and mining incentives, now dwarfs the combined cybersecurity spending of most nations. It's the most secure computing network ever built. And while critics love to point to Bitcoin's price volatility, they miss the bigger picture. Bitcoin isn't designed to be price stable, it's designed to be policy stable. No arbitrary inflation, no emergency rate cuts, no political manipulation.
So stablecoins might be the Web3 app that's really recreating financial services because one, a stable coin works better than a regular dollar. Now, if you want to move billions and trillions, you just use the stablecoin market, and it's proving to be more profitable for a bank. Circle, I won't comment its valuation, but as a net income, or Tether is a better example because it's not public.
How do you trust those Tether people? You don't really know what's going on.
Well, that's where. See, this is where blockchain comes in. Blockchain has proven you don't need to know the counterparty. You just have to trust the code.
Mm-hmm.
And so Tether, from a net income basis, makes more money than most financial institutions. I think would be the third most profitable financial institution in the world. So what's a better bank, right? What's a better financial services model? Is building it on the blockchain. So I think stablecoins is the killer app that's proving, because Bitcoin anchors everything. Because you don't need a stablecoin unless you had Bitcoin. So Bitcoin and building financial services on top of stablecoins, and financial services companies are getting it now. Even Walmart and Amazon want a stablecoin because it's actually quite profitable to have one. That you are changing the financial system through crypto.
Its fixed supply, 21 million coins, ensures it can't be diluted, printed, or weaponized the way fiat currencies often are. And in a world increasingly weary of currency wars, weaponized finance, and hidden inflation taxes, Bitcoin's neutrality is becoming its greatest strength. Meanwhile, stablecoins are quietly absorbing trillions in transactional volume, not just in crypto trading, but in payroll, lending, commerce, and cross-border settlements. And guess what backs many of these stablecoins? U.S. Treasuries. Yes, that's the paradox. The crypto rails that were supposed to replace the dollar are actually reinforcing dollar dominance. Because it turns out what the world really wanted wasn't to abandon the dollar, it was to liberate it from the frictions and failures of legacy banking infrastructure. Stablecoins are doing just that, giving the dollar a second life, one that can now flow through any app, wallet, or network without borders or bureaucracy. Tether reportedly earned $6.2 billion in profits in 2024. More than Goldman Sachs, more than Morgan Stanley, more than most commercial banks. Why? Because holding short-term treasuries and issuing digital dollars is now a better business model than traditional lending. Let that sink in. And if Tether, Circle, and future entrants like PayPal and Amazon start expanding their stablecoin operations globally, they effectively become decentralized central banks, issuing currency backed by U.S. debt, but not controlled by the Fed or any national institution. It's both revolutionary and risky. That's why regulators are watching closely. But make no mistake, the goal is not destruction, it's integration. Already we're seeing efforts from the BIS, IMF, and US Treasury to create frameworks that support regulated stablecoin ecosystems, precisely because they see the writing on the wall. Shutting it all down would hurt dollar dominance, not protect it. Instead, what's emerging is a hybrid system, where Bitcoin provides settlement, stablecoins provide liquidity, and institutions provide trust and compliance layers that satisfy regulators without killing innovation. It's not a return to the old system. It's the birth of a new one, composable, programmable, and global by default. Retail adoption is following quickly. Crypto debit cards are expanding worldwide. Point-of-sale integrations are growing in Latin America, Asia, and Africa. Some employers are paying remote workers in USDC or BTC, bypassing banks entirely. And what's wild is that this system, once mocked as speculative or anarchist, is now the financial OS of choice for millions of people living through currency collapse, capital controls, or institutional distrust. It's no longer about escaping the system. It's about building a better one. And that's where Bitcoin's real utility kicks in, as final settlement. Stablecoins may move the dollars, but it's Bitcoin that secures the rails, ensures there's no double spending, no arbitrary seizures, and no fragile choke points. It's the judicial layer of the financial internet, slow, final, incorruptible. And in a multipolar world where trust is eroding, those characteristics are becoming essential, not optional. This is the convergence, not banks versus crypto, not Bitcoin versus stablecoins. It's about a modular future of finance, one where each layer plays its role. Bitcoin as collateral, stablecoins as money, DeFi as market infrastructure, smart contracts as rulebooks. And yes, the institutions are coming, not because they want to disrupt, but because they don't want to be disrupted. Whether it's BlackRock tokenizing treasuries, Citi experimenting with tokenized deposits, or sovereign nations launching Bitcoin mining programs, the message is clear. The rails of global finance are shifting, and the question is no longer if you should pay attention. The question is whether you're going to be building, benefiting, or bypassed by what comes next. So here's the bottom line. This isn't just about price charts or speculation anymore. It's about infrastructure, about unstoppable code replacing outdated systems, about Bitcoin and stablecoins building a new foundation for global finance, one transaction at a time. If you found value in today's breakdown, don't forget to smash that like button, subscribe, and turn on notifications, because the financial revolution isn't just coming, it's already here, and it's happening faster than most can imagine. Until next time, stay informed, stay sovereign, and stay ahead of the curve.